Hi, everyone. We did our group project on AT&T. We researched AT&T throughout the course and did a few analyses to put together to present for you guys. So my name is Samantha Garretson.
I'm Walter Gregg.
I'm Marcus Aiello.
I'm Mark Augliano.
So to begin, just to give a little background information, as you guys may know, AT&T is one of the largest telecommunication companies in the world. They have headquarters in Dallas, Texas, and just about over 246,000 employees, which was as of the end of 2019. They are a conglomerate holding company, so they are the parent company of multiple subsidiaries, including Warner Media, DirecTV, and Cricket Wireless. In addition, their CEO is John T. Stankey. He was the former CEO of Warner Media. He has the large responsibility of reducing the debt that their former CEO accumulated because during the leadership of their former CEO, he purchased DirecTV for $67 billion, and in 2018, he purchased Time Warner for $109 billion, which we will talk about later in the presentation. So the first finding, again, that we want to talk about is the merger between AT&T and Time Warner. And the reason why it is so significant to us is because of the controversy that it caused. In 2016, AT&T expressed their interest to merge with Time Warner. As you guys may know, Time Warner is a ginormous media and entertainment company. So this meant combining two very large companies, and it definitely brought a lot of attention to it. So in AT&T's eyes and in Time Warner's eyes, this was a formula for success. It was going to be a great merger, and it meant a lot for the communications and media entertainment industry. But not everyone felt the same way, including Donald Trump. He actually had his Justice Department file a suit against the two companies to block the merger. The reason why he felt uneasy about it is because of the amount of power that it would give to a concentrated number of people. In the end, the case was unsuccessful and the two companies merged in 2018. But in 2018, they did merge, but then 2 months later, the Department of Justice filed an appeal. So they wanted to try again to actually undo this merger. And they failed again. So they did end up completing the merge. And the Department of Justice's argument against this merger was that it would add a lot of fees to the cable subscribers each year. So they wanted the merger to be fair to the customers, and they didn't feel that it was. Now, not only did this mean a lot for the Department of Justice, who lost the case, but the New York Times also stated that by challenging the transaction in court, the Justice Department signaled that it would have an aggressive approach to the so-called vertical mergers between companies with complementary businesses. So this related to what we talked about in the class about takeovers recently and how they tend to bring out very strong opinions. So with that said, it was interesting to take a look at AT&T and Time Warner, which was a real-world example.
And just to kind of piggyback off of that, what exactly does this mean for us when AT&T moved into the television and the media entertainment industry? In July 2015, they purchased DirecTV for $67 billion, and that's followed up 3 years later by the purchase of Time Warner Cable, which is now Warner Media, that Sam just spoke about. The problems with this, when they purchased this large media company, it was at the time of declining traditional TV audience. Less people were watching cable TV. There was a rise in a bunch of streaming services like Hulu, Amazon, Netflix, and it kind of put a lot on DirecTV at the time. They're heavily leveraged into a new world, and they lost a lot of confidence from the public, and people didn't believe in the stock. There is a theory that cable companies will survive the streaming war. In August 2016, Warner Cable actually put 10% stake into Hulu for $583 million cash. From there, they actually gave them rights to include TNT's TBS, CNN, Cartoon Network, and Turner Classic on a service provided by Hulu that is closer to cable but still online. Kind of trying to blend the two worlds. From there, they are able to sell and buy rights of cable companies, and they can make money that way and capitalize off this new streaming world.
So to follow up from Denzel there, the current AT&T stock trouble that we went through, we decided to dig a little deeper and kind of see what their current situation was as far as what their upper management is doing. And the stock recently dropped. The reason for that, in an article I read from the Dallas News, we wanted to research the cause of this decrease. The first option we looked at causing AT&T stock to drop was the fact that upper management and AT&T decided to put a hold on stock buyback options. This was in order to maintain financial flexibility and invest in upgrading to 5G. Verizon is currently updated to 5G, and that's kind of where the world is going, I guess, recently. So although we believe that this is a smart move, suspending its stock buyback program did not set well with top financial investors, and it caused the stock to drop 9% in just a matter of months. And this was very recent. And then the article from Dallas News also said that AT&T had a total stock drop of 31% since February of this year. So now we're going to take it into CEO pay, and this goes back to one of the first weeks where we looked at the governance in CEO pay. So we took two other companies, Verizon and T-Mobile, and looked at the amount that the CEOs made based on base pay, stock award, bonus, and incentives. And then we looked at their total cash compensation, total equity, and then any other income that they made. And there was one group of data for Verizon that was interesting and didn't really follow suit with AT&T. The stock award and total compensation went up dramatically from 2017 to 2018 for their chairman and CEO, Hans Vetsberg. But then in 2018 to 2019, it decreased. So that was interesting to see. And we figured that this probably was caused because of, like it said in the Moodle readings and in our book, the CEO in place maybe wasn't working as hard as they should have been, and therefore their shareholders did not benefit as they should have. As for T-Mobile, their stock award grew from 2017 to 2018, and their CEO, John Legere, was very well rewarded. He went from a stock award of $16 million to almost $60 million in 1 year, so that was pretty dramatic. And the shareholders there, I'm sure, were happy to have that large increase, and it's probably due to John Legere pulling in some good wins for T-Mobile, and this would be in the cellular division more so than the television division, but you can see some CEO pay and the governance and how it relates there.
So next we're going to talk about passive versus active investing for AT&T. Moving forward, AT&T would be better looking at a passive investing technique for a multitude of reasons. One of those being for ETFs or exchange traded funds. Those type of investments are very low risk and low cost, and looking long term would be better as far as returns go on those investments. Another one of the reasons is related to beating the market. Now, active investors, they always try to beat the market and find the highest return on it that they can, but that also leads with a high amount of risk. Being a passive investor, we don't have to worry about that. We can throw in small investments in different markets and are okay with waiting for those returns to come in the long term. Ultimately, that way we don't have to worry about a high amount of risk. And finally, for passive investing, is related to the low fees that are incurred on it. That way, we don't have to worry about spending our returns on any amount of fees that are incurred from the different types of investing.